Hello and welcome back to another video. My name is Justin and today we're going to be talking about how there is a 30-year bull break on the TNX, which is the chart I have up right here. There is the potential for a recession risk, and we'll review that in a moment here. But as we're getting started, I want to look at this TNX 30-year bull break because today we had some Fed speakers and on the back of their comments, we are moving higher, notably George. She was talking about how the Fed actually has their fat finger on the scale and owns more than $700 billion worth of bonds. And on that note, we can see here that during the morning, we were a little bit higher here at about 2.4%. And then we dramatically advanced to 2.5%. And the reason for that is because she said that what people are actually discounting is that the Fed owns a whole bunch of these 10-year bonds. So as those start coming back online, people are going to likely be demanding a higher premium. And the yield curve is now uninverted. So this is a dual-edged sword here because as the TNX rises, this is going to add pressure to tech stocks, which were notable today. And this 30-year bull break tells us that this could be a change that is happening that I have not seen in my lifetime because this downtrend started in 1988. And as we're recording this in 2022, it's the first time we've actually broken above this channel here. You can also see that pretty clearly here with the black line, which is going to be the 200 monthly moving average at 2662. If we do repeat today, tomorrow, we will be over. And this matters because we have the Fed meeting minutes coming out tomorrow. So again, FOMC meeting minutes come out tomorrow. This is going to really matter in terms of whether or not we are going to get a bullish or a bearish reaction. So all this means is that the stage is set. We've now bounced off the 50. We're breaking bullish. If it's going to be sustained, we should see that. Also hearing comments from, actually, I'm going to touch on that in a moment here. So second thing I just want to touch on here is that we also saw the dollar move dramatically higher. On the right-hand side, we have the dollar. On the left-hand side, we have the S&P. So over here on the day, the dollar's up by about 0.5%. And on the week, it is up by about 1%. So what I want to just note is that if the dollar was flat, meaning it didn't go anywhere this week, what would have happened? Well, S&P would actually be up by 0.5%. And I'm saying that on purpose because I got a feeling that today people are like, oh my goodness, is the market bear? It is so bear. I'm hoping Justin's going to tell me that we should be folding on support. The answer is no, we don't fold on support. Is this the strongest support? Of course not, but we got a higher low. We have an inside bar in the weekly. That's not an area where we sell, especially if we are trying to invest and have our money work for us, not us work for our money. So my point is that if you love the market yesterday and hate it today, you probably should not have been getting hyper bullish yesterday. The saying is that as good as it feels to make $1,000, it feels 10 times worse losing it. That is likely why you're having a sour reaction to today. So my point here is just that we're going to go through the S&P in a moment and look and see if there's any technical damage, but as of right now, no. It feels bad, but it's not all that bad. We did breach 450. We got it. Higher low, right? 448 went forward last week. We got 44982 this week. So the net effect here is that we're basically unchanged on the week, down by 0.4 and QQQ down by 0.2. I would hardly call that a correction quite yet. In my opinion, though, talking about these Fed speakers, the reason why I think this is so important they did it today is because we know that the last time that we had the FOMC meeting minutes come out, which was notable in January, right? December meeting minutes coming out in January. That is when we got our big old nasty surprise here. Why? The market did not anticipate, and it was quite surprised when we heard they were actually looking to get a lot more hawkish than what was priced in. So I believe that what the Fed has been doing is over communicating going into this meeting minute release, which is tomorrow. So as these meeting minutes get released tomorrow, I believe that they are trying to make damn sure the market sees exactly what they want, which is why I heard George today say that, hey, by the way, the 10-year note is mispriced. There should not be inversion, is what she basically said. And what happened? Boom, inversion went away. So let me just double check and confirm that here. Let's go to a dual board. Let's go USO2Y. All right, there's our 2-year. Right, it's trading here at 2.526. Over here on TNX, let's just go to the 10-year note. Here we're at 255. So it's pretty damn close. It's within about 3 basis points here, but it's not actually inverted. So I believe, like I just said, that the Fed is trying to make sure that tomorrow we're not going to get that big, nasty surprise. Better to drip it down today than have it waterfall tomorrow. It's also really important what time we actually heard those Fed headlines come out. Why? Well, again, let's look here at the 10-year note. And right, looking at the time of the day, booms. So it was already gapping up. And then we exhausted ourselves and then just started flatlining here. But the market did not really start selling off until a little bit later, right? Dead cat bounce, reject off the VWAP, dead cat bounce, reject off the VWAP. So if we would have heard that news into the end of the day, there would have been that overhang going into the close, and the feedback loop would not have been closed. So my point here is just that I think this is actually very constructive. And the reason I say constructive is because now the market has had a chance to price, reprice, and then reprice again one more time to make sure that if there is going to be a surprise tomorrow, we've had a chance to anticipate it and move forward. We also heard from Lael Brainerd today, and we heard from Daly as well, and we heard from Fed Chair Williams over the weekend too. Balance sheet runoff can begin in May. So what does that mean? Well, it means that they could raise by 25, they could raise by 50 basis points, but balance sheet runoff is likely going to start. On the flip side, what I would also note is that we have to look at who our peers are. Right now in the Western world, our peers are Europe. And what is Europe talking about here? ECB's watch says inflation target essentially met. Expects deposit rate raised to 0 by the end of the year. By 0 to the end of the year. ECB's watch says ECB rates could rise to 1.5 to 2% in longer term. The US is still well ahead of that. And the reason I say that is because the ECB has been pulling out this new word in their lexicon. So looking here, they're talking about slowflation rather than stagflation is now the issue. We heard it from, heard this back in October of 2021. We're hearing it again from ECB's not only 4 days ago. So what does that mean? The Fed has a chance to flip-flop again one more time. And the reason I say that is because here is what I have been noticing. We'll look at the S&P here, and I'll just bring up the Fed basically doing a 180 pivot. They told us this inflation is transitory. And then they're telling us that, oh my goodness, is this stuff real? It is hot and it is getting hotter. So what are they doing? They're doing a 180-degree turn on inflation, where they said that before it was transitory. Now they're saying, actually, we were wrong. And now, only even as short as like a couple weeks ago, a couple months ago, they were saying, oh my goodness, the labor market's not quite full. And now everyone, including Jerome, is like, oh my goodness, the labor market's so hot, it's so tight. So what it tells me is that the Fed is doing a 180, and it appears that they are losing credibility. So their words really matter. And that is why I think that today those Fed speakers came out, they were unanimous. No one should now be surprised if we get a 50 basis point hike and balance sheet runoff. And the market has a chance to, sell off into the actual announcement, just like we had with Powell. And the net effect here is that when we spoke with Powell, what did we have? Well, going back here, that's Jerome right there, right? Weekly higher low, and then boomtowns. What do we have here? Oh my goodness, weekly higher low. Is it going to hold? I don't know. The big difference here is that you can now note I have an IHS drawn on SPY. Why? Well, because we've invalidated our head and shoulders. So our head and shoulders would have actually failed right here, and then maybe one more reject at the neckline. That's not what we're seeing. So we're seeing an extended period where now we're actually holding this area, which is why I am now drawing this as an inverse head and shoulders. So let me just make sure I got the rest of the stuff here that's out of the way. We talked about DXY strength. We talked about the Fed 180 pivot. We talked about Fed speakers. Oh, another surprise for tomorrow. So the other thing we could get surprised for by tomorrow is going to be Russian sanctions, the EU today and the USA on Wednesday. So the market was actually quite resilient, in my opinion, because those weekly higher lows held, and there was a plethora or a lot of bad news today. So as we're looking here at the market, again, like I noted, we've now poked about 454 twice. So it is an inside bar. The next break on this candle here is going to be a decisive one. And I'm getting some warnings. We could push back down to the 50 weekly moving average. And for me, that is a strong buy zone. It is not a sell zone. And again, we're roughly flat on the week here. So if the dollar breaches 100, if we get a bull break on TNX, of course, we have to reassess in terms of how we're allocating, meaning If TNX rises a lot more, it's going to add more pressure to growth. So what should you do? Well, maybe don't buy so much growth or wait until we get confirmation. And what I want to do right now is we're going to look at the options chain, and then I'm going to come back and do a quick review on the rest of the stocks. And as you're probably noticing, today's video is a little bit different. I'm trying to get the video done in about 10 to 12 minutes. And I'm just noticing I've got to start wrapping up here. I want to make sure we are jam-packing the value and making sure that it's easy for you to get your recap at the end of the day. Here we go. So this is going to be for the 8th of April. What I want to note here is just the motivation for the move lower today. We've got puts. I'm skipping today. I'm skipping Wednesday on purpose. There were like a million puts here. I don't really care about tomorrow because there's no open interest. I care about what is setting up into Friday here, because if we're going to get a bull or a bear reaction to those FOMC meeting minutes, we should see the motivation here on the tape. So what I'm noticing here is you can see that I got a 450, 445 put spread highlighted, where we got 37,000 in put, volume at 450 OI, 81,000 in volume, 19,000 at 445, 26,000 in volume. So if they want to move it lower by Friday, the motivation's here. And what I would note is that these 445 puts are worth about $1. Oh, wow. Why does that matter? Well, where's our 50 weekly moving average? By the way, it's the blue line right here. So the blue line corresponds with the blue number over here. It's at 443.46. So what that tells me is that if we go down and these 445 puts want to get paid, they basically get their money back at 444. They'll make 50 cents if we go down to the 50 weekly. So what that tells me is that there was open interest. There is added pressure. There's also calls. We're going to focus on the put side in case we get the negative reaction. You guys have been hearing the bull case for quite some time now. So for these guys to get their money back, we have to break below the 50 weekly moving average. So if we come down for a hard landing, I will not be terribly surprised. And as we look forward to the April monthly, which is going to be next Thursday, what I'm noticing here is continuation. And continuation meaning the 450 to 445 put spread OI and volume continuation here. And it looks like we have a 455 and 450 straddle. So in terms of the straddle, it's worth about $50. We either got to be at about 440 or at about 460. So if we start moving decisively lower, I'm not going to ignore it. If we start moving decisively higher, also not going to ignore it. So that's pretty much it in terms of the motivation. If we want to push back down to that 50 weekly moving average, I could definitely see it happening. We would be breaking bearish by falling below 448.14, which on SPY monthly is going to push us down below. Let me just get it prepared here. That's the quarter, that's the year, that's the month. It means that we're going to be losing the start of our IHS here, where we fall below 448.92, which is our December low. I would really like to see us hold that. Again, would not meaning it's going to, right? What the market wants to do and what I want are two different things. All right. So now we know that there is the potential for us to move lower. We've talked about how the ECB is a complete shit show and how America might do better. I mentioned earlier before, too, that I'm thinking that people are probably feeling a little bit of regret today for either chasing things yesterday or for just watching the red today. So if you're scaredy pants, that's fine. The market's not, though. The market is right here, rock solid in neutral territory. So we went from extreme fear to neutral to where we are today. And with all this bad news, it baked it in and we ticked down 1 point. No big deal for me. We talked about the options as well. So I'll just touch on this really fast here in terms of the SPY options. When we were deep down in the dirty dumps, what I noticed is that they were actually going quite hard buying calls here. So what I'm going to do is just zoom in nice and, oops, wrong screen, zooming in on, oopsies. This is from our platform. It's currently still in beta. So you'll note that it's not clean and sexy and polished, but over here, we can note that we got $8.8 million in unusual options coming in for SPY 431 strike going out to June 30th. And we also have 426 May 20th calls being bought for 8.8 million. So for me, what this signals is that when the S&P was at a spot price of 454, they saw that 454.05 area. They bought hard, deep in the money. And this is for continuation post FOMC meeting minutes. So there is some bullish activity that is happening under the surface when we were dipping down. They bought a 454 and they were confident on that. Why? They put $16 million to work. Moving forward to here, we noticed the the fear and greed index. So we're right at neutral. If we're going to move lower, we're going to know. If we're going to move higher, we're going to know. I would still rather be long and long and wrong than short at this point. So now we can look at the heat map. It is a complete 180 versus yesterday. But what I want to do here is actually smooth the data out to a 1 week performance here and to show you that it's not all that scary when you zoom out. If in doubt, zoom out. So what do we note here? Tech is still leading. It's still strong. Chips are mixed. Right over here for railroads, right? Integrated, blah, 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 right? Home Depot, Lowe's, and then financials. Basically all the value. So on a different perspective here, what I want to show you is going to be QQQ, and then we're going to have a look at these individual trillion-dollar companies. So again, down by 0.2. So we basically puked up yesterday's gains. So what? We have an inverted hammer. We are below the 50. It is still our pivot here. We got a lower high and a higher low or an inside tight bar. What I want to show here, though, is that if I go to QQQ on the one-day chart here, so this is going to be our monthly chart. But what I want to show is actually, let me go to the weekly here. So on the weekly, what you're going to note here is that I got a pink line going back here to our October lows. Pink means pivot. It's right there at 350. So what I'm noticing here is that if we look here on the weekly chart, but we zoom into the daily, again, what it tells me is that this 370 area is basically our 200 DMA. And our pink line here is going to be our 50 DMA at 350. So what we could be doing as well, if we are going to get a true move lower on the Fed minutes, is going off the 200 back down to the 50 moving average. And now the question is, when we get, if we print a lower low, I think it's almost inevitable that we go down to 350. Where we react from there, I don't know yet. But what I would say is that if this happens, it's going to feed through to the S&P coming back down to test that 443 weekly 50 moving average here. So if we see a lower weekly low printed on SPY and QQQ, I think it's going to become a self-fulfilling prophecy where we come back down to roughly 445 and down to 350 on QQQ. What I want to look at instead here are, and it's already running a little bit late here, so are the leaders green on the week? Because we noticed these stocks moving up dramatically yesterday. Look, Tesla is still green on the week. So looking at QQQ to start, QQQ is now red on the week. It is less red than S&P. What does that mean? Leaders are still leading. Oh, okay. So QQQ is down less than SPY, but inside of QQQ, are we seeing individual names which are still resilient? I would say yes. Looking here at Tesla, what are we? We are green on the week with a higher low and a higher high. Is it going to hold up? I don't know. But as of right now, the leaders are still leading. Why? They're still green on the week. They're dragging up QQQ. Apple, it's not big green. It's up by 73 cents or 0.42%, but it is green. It's over 175. So Tesla, check. Apple, check. Let's go over to Microsoft. Check. It's up by 0.5%. Boom. There we go. Let's look at GOOG. Oh my goodness. Green on the week by what? $7 or 0.26%, but it's green. Let's look here at Nvidia. Nvidia is red, right? So chips are leading lower. Nvidia is the only one so far which is showing that weakness. Looking at Facebook, it's up 3% on the week still. So in my opinion, the leaders are leading. And if we're going to see that negative reaction with a weekly bear break on QQQ and on SPY, what I would expect to see is that these trillion-dollar leaders are going to start lagging and actually leading to the downside, which means they're going to overshoot down. If that sets up, fantastic. If it doesn't, right, we revert back to our base case where we go up to 454. Bears and bulls fight for direction. The bulls still have the edge, in my opinion, as I laid out. And then we have to confirm by going all the way through to Friday with JP Morgan earnings. And then we got Netflix kicking off big tech on the 15th. If you're curious and watching more, I encourage you to watch the video, which is going to queue up here in a moment. And please make sure to drop me a comment. Do you prefer the shorter videos or the longer ones? And again, I'm trying to do something a little bit different, evolving the channel, and I'm opening and soliciting your feedback. Thank you for watching. Look forward to seeing you tomorrow.